So it's important to know in the S Corp conversation and how it is beneficial. Not only do you avoid self-employment tax and you get to, unlike self-employment tax, deduct your employer taxes that you pay, which reduces your business taxable income. I want to say an S Corp is very beneficial because an S Corp reports its profit and or loss on a separate tax return. It's on an 1120S. And the shareholders, okay, and I'll use myself as an example. I'm an S Corp, gets a K1, and the K1 gets reported on my personal return, right? It's on your personal return. And it's possible to have a profit in your S Corp and still not pay taxes, right? That profit goes onto your Form 1140, your personal tax return, and then you can utilize other facets to offset that profit, right? So you can have a short-term rental and utilize the short-term rental loophole. And when you're utilizing the short-term rental, which is a real estate strategy, you can benefit by meeting the short-term rental requirements, right? Over 500 hours, being heavily involved in the short-term rental as a business, and utilize bonus depreciation, which is a phantom expense, a huge one, and depreciation along with mortgage interest, all of that stuff that causes a huge loss. This huge loss can now offset the profits from your S Corp, your K1, right? And so you still have the Form 1120S that's showing the profit because a profit is a profit, right? Numbers are numbers. But when the profit goes onto your personal return, you may have a short-term rental that meets the requirements of a short-term rental loophole and bonus depreciation, which creates a loss, a phantom loss, a paper loss that offsets those profits and pays no tax. Similarly, you can have long-term rentals in which you meet real estate professional status and again take bonus depreciation, regular depreciation, all the things, repairs, maintenance, that creates a huge phantom loss and offsets the K1 profits. You also can have a business that is not an S Corp, right? That is reported on your Schedule C, much like a short-term rental because it's considered a business, right? If you're going to utilize the short-term rental loophole, it's a Schedule C, but you can have a non-short-term rental business that goes on your Schedule C. Same as if you were a single member LLC, it goes on your Schedule C, right? It's a disregarded entity. So for tax purposes, it's the same. And you can have a loss. Perhaps you want to start another business and you have a loss. That loss can now offset the profits from your K1 from your S Corp, right? Along with any rentals you might have. You may have other K1s that you are receiving because you have an interest in another business that has a loss. Perhaps it's the first year, all that good stuff. That loss will offset the profits from your K1 from your S Corp that is making money. So if you're ever going for funding, you can give the S Corp return, which is the 1120S, right? And show, hey, I'm making money. I would like some business funding, but you still don't pay taxes because all the profits are reported on your personal return, right? And so a bank is going to ask for the S Corp return, which is going to show the profits, which is good for funding. Now, this doesn't really work with real estate. Real estate doesn't belong under Form 1120S for the most part. It's a red flag. But otherwise, if you're running a business that's not real estate and you are S Corp and your real estate is on your personal return like most people, whether it's a Schedule C for short-term rental, whether it's a Schedule E for your long-term rental, and you utilize real estate strategy and not pay tax ultimately on any of the profits, you still get the benefit of getting the profits reported for any funding and for your business credit because you tie that into your DUNS number. That's another conversation, and they monitor your cash flow, which is good for your business credit. So I don't pay any taxes because I'm an S Corp and all of my profits are offset by my real estate strategies and other business ventures, right? And it's strategic. And the only way to do that is to plan in real time, right? To actually plan. The goal of not paying taxes forces you to actively engage in the tax code. So during the year, say now, we're in June, I'm actively engaging. I don't remove myself after March 15th or April 15th, right? I'm always in it. And that's what real wealth building is. You don't get to breathe. And it's not necessarily an arduous process. It's just a constant thinking process. That's all. And you naturally begin to move out of reflex. So if you want to learn more, I have offered a deep discount for the Tax Strategies Mastermind because it has been revamped for ease of automation, and it offers a private community off of social media as well as audit representation once you join and actually apply the methodologies. So I hope to see you guys later and in the mastermind.